The widow's tax trap and IRMAA will crush a $4 million traditional IRA, right? This is financial planner Sean Mullaney. Let's discuss. So if you go out online, you're going to see a lot of personal finance commentary. And it's going to say, don't contribute to those traditional 401ks. Those things are infested with taxes, right? You're going to get to retirement and you are going to be at the mercy of the tax man. You're going to face the tax time bomb on your retirement accounts. You're going to face IRMAA and widow's tax trap. Do not contribute to traditional 401ks. And I think what we need to do is we need to step back and we need to say, well, okay, I hear that contention, but can you show me some numbers? And that's what I'm going to do in this video. I'm going to show you some numbers, and then you get to be the judge and jury as to just how desirable traditional retirement accounts in retirement really are. And I want to stress test it, right? Because one thing to say, well, I retired, I have $500,000 in a traditional IRA. Well, okay, that's probably not going to generate a whole lot of tax, but many in the audience are striving to have a whole lot more in retirement accounts. So what I've done is I've laid out a widow, Bethany, who turns 80 in 2025. And she and her husband were nice people, but they didn't do Roth conversions. What a mistake, right? Now, I do think they probably should have done some Roth conversions. We could talk about that later, but they did none, right? So they got $4 million in traditional IRAs, in one traditional IRA. That's probably from her and her husband's old 401ks. Okay, fine, $4 million. She's got an online savings account of $50,000. She's got a domestic equity index fund in a taxable brokerage of $1 million and a paid off home. So Bethany's doing fine financially, right? But she's got a traditional IRA that's highly tax inefficient, and isn't this going to be terrible, right? So let's start looking at what Bethany's 2025 looks like. Her income has $50,000 of Social Security, $13,000 of qualified dividends, and $1,000 of non-qualified dividends from this $1 million domestic equity index fund. That's about a 1.4% yield, which is actually, in line with where domestic equity index funds are yielding today. So there you go, $2,500, 5% bank interest on the $50,000 online savings account. And then the RMD, oh my goodness, $198,000. What? How do you have a $198,000 RMD, which, by the way, most Americans will never sneeze near, but we're stress testing, right? So $198,000, what you do is you take this December 31st year-end balance, the $4 million from the prior year, and you go to the IRS uniform table, which is in publication 590B, 80 years old. You could see that her factor is 20.2. So all Bethany needs to do is divide the $4 million by the 20.2 to get the 198 and some change, right? So that's a very substantial RMD, which most financial planners will tell you is an awful, awful outcome. And so there you go. So her income for the year is $264,000, which you say, okay, she's 80 years old. She should be able to live just fine. She's got a paid off house. She could probably take some nice trips to see the grandkids, fly first class occasionally, right? She should be fine, at least in terms of her basic needs, but the taxes are where she's really going to lose, right? Well, all right, just how bad are these taxes? When we didn't do affirmative planning, we've got a $4 million traditional IRA, and we're smack dab in the widow's tax trap because we're in the single brackets, not the married filing joint brackets, and we got all this money hitting our tax return, and IRMAA, which we'll come to, right? So Social Security, if we just put together her tax return here, right? We start with Social Security, 42.5, that's 85% taxable. We'll come back to that later. 85% taxable. Okay. Qualified dividends, non-qualified dividends, $14,000 total. Interest income's $2,500. The RMD is the 198. So her adjusted gross income is $257,000. Oh my goodness, boy, that's going to be a problem, right? Now we get some relief though. Standard deductions, $15,000. Let's do the additional standard deduction. Bethany is 65 or older, so she gets $2,000 more, so that's $17,000. The non-qualified dividends are generally going to be 199A REIT dividends, 199A dividends, so she'll get a $200 qualified business income deduction on them. Her taxable income is just a smidge shy of $240 by my estimate, and she's just a hypothetical person. So her federal income tax by itself is $52,000 by my estimate. And it's interesting, her marginal rate is 32%. And if we go to the CNBC thing, this is for single tax filers, right? That's Bethany. She's a widow, so she's single. And if you look, she's going to pay the last dollar of ordinary income. It's about $30,000. Will attract this 32% tax. So that's a high tax, right? But it's only on the last roughly $30,000. The rest of that income goes through the 10% bracket, the 12% bracket, the 22% bracket, and the 24% bracket. So keep that in mind. Okay, let's go back here to Bethany. Now, Bethany owes the net investment income tax too. It's not just income tax she pays. Oh no, net investment income tax. But in her case, actually relatively minor, just $600. When you're making $260,000 a year, you could probably withstand that. Nobody likes to cut that check, but she's okay. And then Irma. So this is something that you're going to hear in the personal finance space. Irma. Oh my goodness, how bad is Irma? And what it is it's an increase in Medicare premiums when your income is too high. It's based on 2 years ago. So by using the $257,000 of adjusted gross income, I'm sort of bringing that forward. But presumably Bethany at 78 had a tax return that looked a lot like this. So I think it's a decent assumption. I want to be conservative. I want to be against my own sort of theory here. So $5,800 of Irma. And you step back and you say, well, that's no fun. Nobody wants to cut that check to Uncle Sam. But does it have anything to do with their lived experience, right? People trot out Irma as if it's the worst outcome in the world. Generally speaking, it's a nuisance tax. This is what, 2-3%, not even, right? She's going to be fine, right? I'm not here to say we always just write off $50 because it's only $50. No, but we do have to step back and say, well, it's not a disaster if we have a nuisance tax when we're making $260,000, right? I wouldn't stop 401k contributions because of Irma, which is this little nuisance tax, right? Nobody likes to pay it, but it has very little to do with Bethany's lived experience. So, okay, her total tax, when we add up Irma, net investment income tax, and the income tax itself is about $58,000, right? So the effective rate on her income, on her 264 income, look at that, is 22%. Is that really a tax time bomb? Right, that's what it would have looked probably higher during their working years to build up the $4 million traditional IRA. Their marginal rate would have been, in 32%, plus they'd be paying FICA taxes back then, which are, higher than Irma, that's for sure, right? So, this isn't the best outcome. She probably should have done some Roth conversions to stop that 32%, but that was only on $30,000, right? So I don't think this is that bad of an outcome. And that's with no planning. She should have done some planning. Okay. And by the way, this is with a $4 million IRA, which is not a likely outcome. And this is in the widow's tax trap. And this is, all the boogeymen hit. And it's a 22% effective rate. Well, okay. Not great, but not awful. The other thing, too, is just remember, her and her husband deducted at 32% into the 401k, 24% into the 401k. So on many of these contributions, they're winning because it was taxed against 12%, 22%, 24%. But okay, fine. Last few dollars definitely got dinged. She lost on the last few dollars, or maybe it was tied because it was 32% on the way in, 32% on the way out. But okay, fine. Now, I think we have to step back and say, just how impactful is having all traditional retirement accounts and having the tax on all that to Bethany's lived experience? The percent of her financial wealth she pays in federal income tax in the widow's tax trap with Irma, with a $200,000 almost RMD, is 1.15%. And if you just say, well, all these taxes, let's just attribute them to the traditional IRA. She pays 1.45% of that traditional IRA to Uncle Sam. You're going to hear commentary, I've heard this, where commentators say, you have that traditional IRA, the government owns 30% of it. Well, wait a minute, they own 30% of it, you're saying to me, but this year, when she was in the widow's tax trap and faced Irma, she paid 1.45% of that account to Uncle Sam. That's it. right? The IRS owns 30% of it, but they only got less than 1.5% of it this year from someone in the widow's tax trap. Really? I've joked about this on the channel before, but if I ever have business partners, I hope you guys are as bad at collecting as the IRS is, collecting from traditional retirement accounts. They barely got anything, right, from a percentage perspective. So I would say, look, this isn't a bad outcome, right? Yes, it could be better if she'd done some Roth conversions earlier in retirement. I agree with that. But this is sort of saying the tax time bomb ain't that much of a time bomb, right? Uncle Sam got well less than 2% of the traditional retirement account in the widow's tax trap. And then the other thing to think about is Social Security. I said, well, she's in the 32% marginal bracket. Well, if this proposal to get rid of the taxes on Social Security goes through, she'll be in the 24% top marginal bracket, right? Her taxes are going to go down even more. So I would say that traditional retirement accounts are very good for most Americans. And it tends to be that in retirement, we're lightly taxed. Think about when Bethany and her husband were in their 30s. Even if they accrued $1 million by that point, right? They'd be paying, on this level of income, they'd be paying a similar amount in tax, and they'd be paying FICA tax. So they'd be paying, 5%, 6%, 10% of their wealth every year in taxes. Nobody talks about the tax time bomb when you're working and you're paying 5, 10% of your wealth every year, maybe more. For many Americans with a very low wealth, it could be a lot more. And then in retirement, a very affluent, inefficient retiree pays 1.15, 1.45% of their wealth in taxes. So let me know what you think of traditional retirement accounts. Do you agree with me, or do you think it's got to be Roth, Roth, Roth? Let me know in the comments below. Thanks so much for watching. And if you enjoyed this video, please smash that like button and subscribe to my channel. I'll see you next time.